Hi, my name is Paul and welcome to my channel. On this channel, we're going to talk about tech, we're going to talk about health, and we're going to talk about startups. So make sure you hit that like and subscribe button. So OpenAI just announced a $6.5 billion funding round. That's the biggest funding round ever in the history of venture capital. $500 million worth of that amount is being funded by Masayoshi-san of SoftBank. And it's pretty curious how we have reached the point of funding rounds worth $6.5 billion. And yet, Microsoft alone was funded with only $1 million. So how exactly did we get to the point of these massive rounds of venture? So in this video, we're going to talk about how in the world venture capital got so bloated to the point that we need this much funding for our companies. So stick around for the rest of this video. So the modern landscape of venture capital really started in the 1950s, the 1960s, when Intel raised about $2.6 million worth of funding. At the time, that was pretty huge because no other tech companies were really raising that much money. And this was really the beginning of Silicon Valley and its rounds of venture. However, over the next 40 years or so, there wasn't a lot of progress in terms of how much money people were raising. Microsoft only raised $1 million in '79. Apple only raised 750 grand from the investors. That wasn't a lot of money at the time, even if you account for inflation. And yet, in the 1990s, that's when the real venture capital landscape started to change. With the rise of internet companies, especially in the .com era, a lot of companies started raising real money and companies started growing from in the venture capital landscape. Amazon raised $5 million up until 1995, and yet it had not shown a single dollar in terms of profit. Pets.com alone raised $82.6 million, and yet it never returned a real profit. So what exactly happened in this era? With the rise of these companies at the time, there was a lot of hype that a lot of venture capitalists were just too excited about how much money these companies were making. Netscape made a lot of money and raised a huge round of venture, and was later sold to another company. So a lot of investors were seeking a lot of golden geese so that they get massive returns from their investments. So big rounds of venture, especially in the late 1990s, led to this rise in cash in the tech landscape. So let's talk the .com bubble. At the time, when investors were super hyped about how much money companies with the term .com were making, investors started pouring in a lot of money. And from like 97 to 2001, there was a lot of funding poured into Silicon Valley. And at its peak in the year 2000, the curve kind of crashed. There was an influx of cash. The stock market went haywire, and it crashed in like the year 2000. A bunch of companies lost their money. A lot of investors went to zero. Pets.com, with its $82 million invested, went to an absolute zero, and a bunch of other companies completely lost all their cash. This was the first true big funding round in Silicon Valley. A lot of investors lost a lot of money, but it gave people a lot of confidence with how much exactly they could produce, and how much money exactly would be invested in these internet companies. And in the 2000s, we started to see a change, and we started to see a lot of these companies growing, and a lot of investors now started pulling in large amounts of money. But for a certain period between 2001 and 2008, there was a real stall in terms of how much money investors were pouring into companies. So that's when accelerators like Y Combinator came to exist, because there was slow growth. in terms of venture capital. And with the crash in 2008, everything really got worse. But the market started to pick up around 2009. So 2009 to 2020, we saw massive rounds of venture, massive rounds of venture. So Airbnb, Uber, Tesla, companies like that, so huge funding rounds, because the venture landscape at the time had matured. Uber alone, up to date, has raised $5.6 billion. $5.6 billion could run a small country, probably. But that much money invested into a company that has only been profitable for about 2 quarters now. I think 2 or 3 quarters. Uber has not been profitable for a long time, and it just started being profitable in 2023. So $5.6 billion, almost no profits. These investors are primarily looking for future returns, like 2040 maybe. That's when they are really looking for their big returns. So in the 2010s, we saw this type of maturity in the venture landscape. Airbnb has raised 5.6, I think 5.4 or something like that, another $5 billion. At the time, another company, WeWork raised, I think, $13 billion, which is excessive amount of money, especially in the real estate landscape. So every company at the time was raising a lot of money. It didn't matter the industry. You could be in cars, you could be in finance, you could be in real estate. You'd raise huge amounts of money, and you'd really see, you'd see the benefits, and you'd see the profits. You wouldn't really see the profits, but there was just a lot of money being poured into these companies, and a lot of companies would grow really fast, from 0 to 5,000 employees in just a couple of years. So this was the time of the mega rounds, especially with the growth of the American market. The American market saw a massive bull run from 2009 up to 2020. 2020, it kept going up. With the market being in favor like that, with banks having low interest rates after 2009, because of the whole housing crisis and because of the crash in the stock market, a lot of banks dropped their interest rates, especially in America. So due to those low interest rates, big venture capital funds like Sequoia, Market A16Z, they were able to raise huge amounts of money so that they fund all these big companies. And with the growth of external investors as well, Saudi Arabia and the European market, the Arabs up in the Middle East, they kept pouring a lot of money into the venture landscape. So all of this led to the growth of these mega big rounds, which is leading up to OpenAI this year raising this $6.5 billion. The other reasons why the rounds have been so big, apart from the fact that there have been low interest rates, there has been a lot of money being poured into the market, is because the culture of Silicon Valley has generally encouraged companies to grow really, really fast. This is a term Reid Hoffman called Blitzscaling. So Blitzscaling is when a company grows from 0 to 1,000, a couple of thousand employees, in a space of a couple of years or a year, or really, really fast growth that generally cannot be done in other circumstances. A lot of big companies, a lot of these companies which I previously mentioned, Airbnb, Uber, Tesla, that's what they did. They grew really fast, and to grow at that pace is only possible if you have really, really huge amounts of money. And if you want to build that kind of technology, you're going to need, if you're going to build really big technology, for example, Tesla and its cars, they need a lot of money to manufacture the cars and things like that. So they needed huge influx in terms of capital. So that's another reason why that's another reason why Silicon Valley has been leading in terms of producing these big companies. So what exactly have these big rounds caused? There's a good and there's a bad of having this much venture capital in the economy. On one hand, it allows the growth of companies, and it lets people try and fail, and it gives a lot of room for growth for the founders. For example, Amazon had a lot of debt, and it piled up a lot of cash. It piled up a lot of cash, venture capital, really early on in the company, such that it was able to boost its growth for quite a long time. And even though they made mistakes early on, they didn't really pay so much. They didn't really pay so much for their mistakes. So that's kind of one hand. On one hand, that's kind of the good part about having all this, about having so much cash in the ecosystem. However, the other side of the coin is you get some bad results. For example, WeWork is a typical example of we had too much money, so we burnt out. If you haven't seen it, you should watch We Crashed on, I think it's on Apple TV or something. Watch the show. It's pretty good. They raised $13 billion. My country's GDP is $46 billion. That's a third of our GDP. They raised that much money and they burnt it out in like 4 or 5 years. They had a lot of offices in America, in Europe, in Asia, whatever. But they were able to burn all that cash, and a lot of investors were burnt in the process. $13.6 billion lost. They went bankrupt in 2020, I think, because of a failed IPO. All of that was because, well, basically they had too much money. So because they had too much money, they're able to spend it in like super reckless ways, parties, drugs, planes, whatever they wanted. But yeah, that's a classic case of we had too much money and it went wrong. In other cases, too much money works. Too much money worked with Tesla. Too much money is working with Airbnb. Too much money is sort of working with Uber. But we're really yet to see how that goes. So yeah, is it good or is it bad to have this much capital in the market? It's probably better than it is worse to have this much money. In terms of smaller developing countries, you always need more capital allocation. More capital is generally better than less capital, especially in the underfunded places like Africa and some parts of South America. The companies are not really funded as much. But as we grow, we'll be able to get more venture capital in. Hopefully we'll be able to get more influx in venture capital. So yeah, that's about it for the video. Make sure you hit that like and subscribe button, and yeah, tune in for the next one.